Most people think market crashes are caused by bad news arriving suddenly without warning. They're wrong about this fundamental misunderstanding of markets. By the time the news arrives in headlines on television or newspapers, the market has often already made its decision long before. Months of preparation by smart money have already positioned portfolios. Smart traders don't just watch prices moving up and down every day. They watch something far more important that most people ignore completely: volume. The quiet signal hiding beneath every major market move, waiting to be discovered. Because long before a market crash appears in headlines and frightens ordinary people, the market usually whispers a warning to those paying attention. Not through prices rising or falling dramatically, but through trading activity shifting beneath the surface. And those who understand the signal sometimes see the storm coming before everyone else notices it. Institutional traders have built fortunes on this principle. But here's what most people miss or fail to understand. Volume isn't just a technical indicator that charts show you. It's a window into how money is moving inside the financial system. And throughout history, some of the biggest crashes in the world have left the same footprint before they happen. Understanding these patterns can help investors prepare for the next crisis. Most investors focus on one thing obsessively every single day with religious dedication: price. They watch charts moving up and down constantly. Green candles going higher every day. Red candles dropping lower suddenly. New highs breaking records. Sudden drops creating fear and anxiety. But price only tells part of the story about what's really happening in markets. Because price shows where the market ended the day, it doesn't reveal the full battle that happened underneath during trading hours. That battle happens in volume silently. Volume shows how many shares, contracts, or assets were actually traded during the day. It shows how much money moved between buyers and sellers. And more importantly, it reveals who might be moving that money. Large institutional investors like hedge funds, pension funds, and investment banks control enormous pools of capital. When they start buying or selling, it rarely happens in one dramatic moment. It happens gradually over weeks and months, quietly without announcing intentions publicly, piece by piece accumulating positions. And this is where the story becomes interesting to students of markets. Because sometimes, before markets crash spectacularly, volume begins to change in unusual ways. The pattern becomes visible to those watching carefully. To understand this pattern deeply, we need to go back to one of the most famous financial disasters in history, the Wall Street crash of 1929. In the late 1920s, the stock market was booming dramatically and seemed unstoppable. Investors believed prices would rise forever without limit. Speculation exploded into mania. Ordinary people borrowed money to buy stocks they couldn't afford. Margin buying allowed people to control stocks with only 10% down. Optimism filled the financial world completely. Banks encouraged borrowing and speculation. Newspapers promoted stocks daily. Radio broadcasts celebrated market gains. Everyone seemed to be getting rich quick. Barbers gave stock tips. Shoeshine boys discussed market picks. It was a cultural phenomenon. But beneath the excitement and enthusiasm, something unusual began happening that few noticed or cared about. Trading volume started rising sharply during market sell-offs and declines. Large investors were quietly exiting positions accumulated over years. The smart money was leaving silently. They weren't panicking or selling everything at once. They were distributing shares gradually, selling into strength while the public kept buying eagerly, using public enthusiasm to exit positions. Then came Black Thursday in October 1929. Panic spread like wildfire through the markets. Massive sell orders flooded the market simultaneously. Everyone tried to sell at once. Prices crashed. Margin calls destroyed investors who had borrowed money. And within days, the stock market collapsed completely. But if you looked closely at the numbers, the warning signs had been there for months. Volume had been telling a story long before the crash became obvious to everyone watching. And this pattern didn't just happen once in history. It appeared again decades later during other major crashes. During Black Monday, when global markets suddenly plunged dramatically. Leading up to the crash, trading activity began surging noticeably and intensely. Large blocks of shares changed hands in institutional portfolios. Institutional investors were repositioning their portfolios. Smart money was exiting stocks. Then it happened suddenly. In October 1987, the Dow Jones Industrial Average dropped more than 20% in a single day, one of the largest single-day declines in financial history ever recorded. The crash shocked everyone. Then came the circuit breakers and market halts. Again, the price collapse looked sudden and shocking, but beneath the surface, the market had already been shifting. The volume signals were there for observant traders. Then history repeated itself during the dot-com bubble in the late 1990s. Technology stocks soared to unsustainable levels. Investors poured money into internet companies with no earnings. Valuations reached extreme and ridiculous levels. But while prices climbed higher continually, volume patterns started changing subtly. Smart money began reducing exposure to technology stocks, taking profits quietly. When the bubble burst in 2000, trillions of dollars vanished from the stock market. Investors lost fortunes. Retirement accounts were devastated. And once again, those watching volume closely had seen unusual activity beforehand. The pattern appeared again before the global financial crisis of 2008, the worst financial disaster since the Great Depression. In 2007, markets still looked strong and healthy to most observers. The S&P 500 was near record highs and climbing. Housing prices were booming across the country. Confidence remained high among investors and bankers. Banks were lending aggressively to anyone who could sign papers. Subprime mortgages were packaged into securities. Leverage was everywhere. But beneath the surface, institutional trading activity began shifting noticeably. Volume increased during market declines significantly. Banks and hedge funds started reducing exposure to risky assets quietly. Credit markets tightened as lenders became cautious. Liquidity began disappearing from the system. The smart money saw the dangers ahead. Then, in 2008, the financial system cracked completely. Major institutions collapsed overnight. Lehman Brothers failed spectacularly. Investment banks needed government bailouts. AIG needed rescue. Merrill Lynch sold for pennies on the dollar. Markets plunged more than 50%. Trillions of dollars in wealth vanished. Unemployment soared. Foreclosures devastated families. And the global economy entered the deepest recession since the Great Depression. To the average investor watching television, the crash seemed sudden and shocking. But for traders watching market structure and volume carefully, the warning signals had been building for many months. At first glance, volume seems like a simple statistic without much meaning or importance. Just a number showing how many shares were traded during the day. But for experienced traders with years of market experience, it represents something much deeper. Participation, commitment, belief in the market direction. Volume reveals how strongly investors believe in a market move. If prices rise but volume is weak and declining, the rally may lack conviction. If prices fall with massive volume, it suggests powerful selling pressure from large institutions. And sometimes, the most important signal happens when price and volume diverge from each other completely. Prices may still be rising higher day after day, but volume quietly shows that large investors are leaving the market. This process is known among traders as distribution. Large institutions sell gradually while the public keeps buying eagerly. They cannot sell everything at once without crashing prices immediately. Their positions are too large to dump instantly, so they distribute shares slowly across weeks or months. To the average investor watching daily prices on television, the market still looks healthy, but the foundation is weakening underneath. Conversely, accumulation happens when volume rises during price declines significantly. Smart money buys while prices are low and attractive. This creates volume spikes down. Then when prices rise on lower volume, it shows retail investors chasing prices higher. This divergence between price and volume is where the real information hides. Professional traders profit from understanding these patterns. They position themselves ahead of the crowd. Today's markets are faster and more complex than ever before in history. Algorithms trade in microseconds, automatically executing thousands of trades. Global markets are connected instantly through electronic systems. Trillions of dollars move through financial systems every single day. Information travels at the speed of light globally. Central banks coordinate policies across continents. But despite all this technology and speed advancement, the basic structure of markets has not fundamentally changed. Large institutions still control the majority of capital. Retail investors still follow trends after they start. And volume still reveals where the biggest players are moving their money. During the COVID-19 stock market crash in 2020, trading volumes surged dramatically. Before markets reached their bottom, massive institutional activity flooded the market. Some investors were selling aggressively in panic. Others were buying historic bargains at discount prices. The same signals appeared again. Exactly. Young investors who studied historical crashes recognized the pattern. They bought during the panic. Markets recovered within months. Wealth was made by those who understood volume signals. Because even in modern markets with computers and algorithms, human behavior hasn't changed fundamentally. Fear drives selling in panic. Greed drives buying in rallies. Herd mentality moves crowds. These emotions drive financial markets just as strongly today as they did a century ago. Technology has changed the speed of trading, but not human psychology. The deeper lesson here isn't just about technical analysis and chart patterns that traders study. It's about understanding how markets really work underneath all the noise and distraction. Markets are not moved primarily by headlines in newspapers and cable news. They are moved by capital flows from large institutions, where money enters the market, where money exits the market, where institutions reposition billions of dollars at a time. Volume gives traders a glimpse into those movements. It doesn't predict the future perfectly. Nothing in finance does with certainty, but it can reveal when the balance of power inside the market is shifting. And sometimes, that shift happens long before prices fully react to the change. A trader who sees volume surge on down days knows something important is happening. Institutions are buying or selling. The crowd hasn't caught on yet, but when they do, the move accelerates. Understanding this timing gives traders an edge. This edge has made fortunes and saved investors from massive losses. Financial markets often appear chaotic and random to ordinary observers who don't understand what's happening. Prices rise and fall unpredictably every day. News changes every hour without warning. Experts debate endlessly about what will happen next quarter. Markets soar on hope and optimism. Markets crash on fear and pessimism. Volatility spikes without explanation. That makes sense. But beneath that noise and chaos, markets follow deeper patterns. Patterns created by human behavior over centuries. By fear and optimism that never changes. By the slow movement of enormous pools of capital. By institutional investors positioning ahead of changes. Volume is one of the few signals that exposes those patterns clearly. It shows when confidence is growing among big players, and when it's quietly fading away, silently. Because before markets crash dramatically, they often whisper their warning, not through headlines in newspapers, not through dramatic price moves shocking everyone, but through the silent surge of trading activity beneath the surface. Observant traders hear this whisper. They position accordingly. They profit when others panic. And those who learn to listen closely to volume signals sometimes hear the signal before the crowd reacts. This is how fortunes are made. This is how investors protect themselves. This is how you survive crashes. By understanding volume before the headline. If this gave you a new perspective on how markets really work underneath the surface, then you've understood something important about financial systems. The most important financial signals are often the ones hiding in plain sight. Volume speaks louder than prices. If you learn to listen, understanding how capital moves through markets is more valuable than watching daily news. Smart traders have known this for decades. Now, you know it too. The next crash will come eventually. Markets always correct after rallies. When it happens, watch volume carefully. It will tell you what's really happening. It will show you when institutions are buying or selling. It will reveal the whisper before the crowd hears the roar. This knowledge is your edge. Practical application matters tremendously. When you see prices rising but volume declining, be cautious about the rally. When you see prices falling but volume surging, pay close attention. Look for divergence between price and volume carefully. Watch for distribution patterns where smart money is exiting. Watch for accumulation patterns where smart money is entering. Study the 1929 crash and Black Monday carefully. See the volume patterns before each crash happened. Then apply those lessons to today's market. Stay alert every single day. Watch volume patterns closely. Listen to the market's whisper. Don't ignore the signals. Your future returns depend on it. This is how fortunes are made. Smart traders have known this for decades. Now, you know it too. The next crash will come eventually. Markets always correct after rallies. When it happens, watch volume. It will tell you what's really happening. It will show you when institutions are buying or selling. It will reveal the whisper before the crowd hears the roar. This knowledge is your edge.